Every month, I make my stocks to buy videos, which showcases stocks I think are looking cheap and interesting in the market. I am someone who believes there is always value somewhere. And in this video, we're going to discuss 5 stocks that I think are looking undervalued in the month of August. I was waiting until all the major earnings were reported before making this video. And now that most earnings reports are over, I can give you a better and more up-to-date opinion on all of these stocks. However, before we get into the video, I want to let you all know that Stock Unlock's sale is ending tonight. So if you have been waiting to check out or subscribe to Stock Unlock, then do not wait. The sale is about to end. Stock Unlock is the portfolio tracking and stock analysis tool that I use here on my channel, and it is truly the best valued stock platform on the internet. You can check it out for free without a credit card, and again, today is the day to do so because you can lock in huge savings if you do decide to subscribe. But with that being said, let's now hop into the 5 stocks that I think are looking interesting in the month of August. Alright, so the first stock that I want to talk about in this video is Visa. Now, this is not a stock that I talk about very often, but Visa is currently in about a 10% correction from its all-time highs. It's actually down about 10.7%. And the underlying fundamentals of this business have been continuing to grow. I've also said before on my channel that Visa is one of the highest quality stocks I've ever seen in the stock market, so I am always interested in this one whenever it does see a pretty significant correction. So I went over to Visa's most recent earnings report, and here we can see that its revenue did grow by 10% and its earnings per share grew by 20%. And on an adjusted basis, its earnings per share grew by 14% year over year. So Visa's revenue and its earnings are continuing to grow. The business also showed that its payments volume was up 7% year over year, and its processed transactions were also up 10% year over year, which does make sense because again, the revenue is also up 10%. So overall, it does look like Visa's business is continuing to grow. Visa also shows us a lot of different graphs and metrics within its earnings report. And here we can see its 2024 US payment volume growth has been decelerating over the past few months now. And as of July 1st, the total payments volume growth is actually continuing to come down. If we take a look at the 2024 processed transactions growth, we can also see that its growth rate is starting to come down. And I think that this could be partly why Visa stock is in a slight correction right now, is because it seems like its growth rates are starting to slow down. However, Visa also gave us their outlook for the full year of 2024, and they are expecting revenue growth to be in the low double-digit range, and they are expecting their earnings per share growth to be in the low teens. So it does seem like Visa is still expecting overall revenue growth and decently strong revenue growth for the remainder of 2024. Now, if we quickly go and take a look at Visa's financials, we can see that its revenue is currently sitting at an all-time high of roughly $35 billion. So it seems like Visa's business is continuing to grow very well. We can also see that Visa's operating income is hitting all-time highs and continuing to grow. And operating income is actually the number one metric that I use when I am looking at Visa's business and trying to value the business. And the reason for that is because Visa's operating income seems to be the most consistent profitability metric. So if we head over to Stock Unlock's freeform tool and we take a look at Visa's price to operating income over the past decade, we can see that currently it is trading for 22 times operating income. And the company's long-term historical average is about 23.5. This does suggest that Visa is trading slightly below its historical average price to operating income ratios, and therefore the stock could arguably be looking cheap relative to how the market has historically valued this business. And for that reason, I did want to put Visa in this month's video because it is an extremely high quality business that is currently trading below its historical average price ratios. Lastly, if we go and do a quick discounted cash flow calculation on Visa stock using its operating income over the next 5 years, and we say that Visa continues to grow its operating income at roughly 10% annually, which is its 5-year average operating income growth, if the company continues to buy back 2% of its shares on an annual basis, grow the dividend by 10% annually, and trade for a price to operating income of 23, which is the company's long-term historical averages, then here we can see that the stock could produce returns of about 14% annually over the next 5 years, which is a market-beating return. And in my opinion, 10% annual operating income growth for Visa is probably doable. It's not super optimistic, and it's also not super conservative though. So in my opinion, I do think that this DCF calculation right here is kind of in the mid-range for what Visa's potential over the next 5 years is. And if Visa can basically continue growing its business at its same level of growth and continue this growth rate over the next 5 years, then the stock, again, could produce a market-beating return. And for that reason, I wanted to include Visa in this month's video. All right, now the second stock that I want to talk about in this video is Amazon, because Amazon stock is currently in about a 17% correction from its all-time highs after the company reported its second quarter earnings results. And in my opinion, the earnings results were actually pretty good. They weren't like a blowout quarter or anything like that, but it wasn't a bad quarter by any means. Amazon's business is just continuing to grow, and the overall profitability of this business is continuing to grow as well. So I don't personally think that a 17% correction in Amazon's share price is currently warranted after the earnings report, and for that reason, Amazon is making it into my monthly video once again. I also covered Amazon's second quarter earnings results in depth here on my channel, so if you haven't seen that video and you want to go and get my full analysis on Amazon's second quarter results, then I would recommend going and watching that video as well. So to start off our Amazon discussion, I want to cover why I think that Amazon stock is down. And in my opinion, it is because some of Amazon's main growth segments of the business are seeing a deceleration in the overall growth rates. For example, here we can see that the third-party seller services segment of Amazon's business grew by 13% year over year, but in the fourth quarter of 2023, it was growing by 19% year over year. So the third-party seller services segment of Amazon's business is seeing its growth rates decelerate. This is the exact same story with Amazon's advertising business. In the fourth quarter of 2023, it was growing at 26% year over year, and now it is growing at 20%. And once again, this is the same story with the subscription services business with 11% year over year growth. So these three highly profitable segments of Amazon's business are seeing their growth rates start to come down. However, if we take a look at AWS, its growth rates are starting to re-accelerate. In the third quarter of 2023, AWS grew its revenue at 12% year over year, and in the second quarter of 2024, it has now kicked up to 19% year over year growth. So AWS's revenue growth rates are starting to pick up once again. And I do think that this is a very good thing for Amazon's overall business for a number of reasons. And the first reason is because Microsoft's main competitors, which are Google Cloud and Microsoft Azure, did see their year over year growth rates start to come down in the second quarter of 2024. However, if we take a look at AWS's year over year growth, I added in my own line right here, and we can see that it is starting to pick up. So while these other cloud providers are seeing their revenue growth rates start to tick down in the most recent quarter, Amazon's is continuing to tick up and see accelerated revenue growth. So Amazon is clearly the outlier in the cloud space for this quarter. And again, I do think that this is a very bullish point for Amazon's business. Now, additionally, AWS is a highly profitable business for Amazon. And AWS's growth rates are well above Amazon's overall revenue growth rates. And what this means is that AWS is becoming a larger and larger piece of Amazon's business over time. For example, in the trailing 12 months, AWS's revenue made up 16% of Amazon's overall revenue now. And if we take a look at the 2020 numbers, we can see that AWS was doing about $45.4 billion in revenue, which was about 12% of Amazon's business at the time. So over the past 4 years, AWS has grown by roughly 4% of Amazon's overall revenue, and now makes up 16% of the company's overall revenue that it generates. And again, this is a highly profitable business. And as AWS continues to grow at a faster rate than Amazon overall, it is going to continue making up a larger and larger portion of Amazon's business, and therefore, Amazon's overall profit margins should continue to expand as this happens, especially with the advertising business and the third-party seller services business continuing to grow at fast growth rates as well, because those are highly profitable businesses or business segments that Amazon has. In fact, if we take a look at Amazon's ads business revenue versus YouTube revenue, we can see that Amazon has done about $51.3 billion in the trailing 12 months now, and YouTube has done about $33.9 billion. Now, if we take a look at the second quarter of 2021, these two businesses were basically at the same level right here, producing about $25 billion in revenue. However, over the past 3 years, Amazon's ads business has doubled in revenue to that $51 billion, whereas YouTube has only grown to about $34 billion in a trailing 12 months revenue. So Amazon's ads business is faster growing than YouTube. And YouTube is seen as one of the gems of Google. So I think that people are kind of sleeping on Amazon's ads business, because this is a massive business that is still growing at 20% year over year, which also makes it one of the fastest growing advertising companies in the world. So I think that this is also a major segment of Amazon's business. And as this segment continues to grow and produce profits, then Amazon's overall profit margins should continue expanding. Now, if we head back over to Stock Unlock, we can see that Amazon is now producing about $108 billion in operating cash flow. And in general, we can say that Amazon's operating cash flows are continuing to explode and grow extremely quickly, and also hit new all-time highs. Amazon's operating cash flows have also been the most consistent metric for this business historically, so this is the metric that I use to value Amazon's business. And when we take a look at Amazon's historical price to operating cash flow over the past decade, we can see that its average has been about 27.2. And today, the company is trading for a price to operating cash flow of only 16.2. So it is trading well below its historical average price to operating cash flow ratios. And this suggests to me that Amazon stock is not expensive in the market and could arguably be significantly undervalued relative to how the market has historically valued this business. In fact, if we want to find the last time that Amazon traded for a 16 price to operating cash flow, we have to go all the way back here to 2010. So this is the lowest price ratio that Amazon has sold for over the past 14 years. So this is the cheapest that Amazon stock has been in 14 years relative to the operating cash flows that this business generates. To put this in even more perspective, if we go over to the stock market crash of 2020, Amazon's business was trading for a price to operating cash flow of 21.8. So Amazon stock is cheaper than it was during the stock market crash of 2021, again, relative to its operating cash flows, because Amazon's operating cash flows have absolutely skyrocketed, but the stock price hasn't really gone anywhere for the past about 4 years now. And this overall has compressed the price to operating cash flow metric down to a level that it hasn't seen in 14 years. And for that reason, I do think that Amazon stock is undervalued in the market today and looking quite cheap. Another thing that I found very interesting is if we add in Google, Microsoft, and Apple to our freeform tool here, and take a look at all of these companies' historical price to operating cash flow ratios, we can see that Amazon, all the way back to 2011, was always on top. So relative to all of these companies' operating cash flows, Amazon was always the most expensive business by a pretty wide margin as well. However, if we zoom in now, we can actually see that Amazon is the cheapest stock relative to its operating cash flows. Again, sitting at that price to operating cash flow of 16, whereas all of the other businesses are trading at least around 20 or well above 20. So it's just super interesting to me that historically, Amazon has been the most expensive stock by far out of this group, but now it is the cheapest stock by quite a wide margin out of this group today. So it seems like the market has kind of shifted the sentiment, and now the market is much more bullish on Google, Microsoft, and Apple than it is on Amazon. And I think that this is kind of a mistake because personally, as an investor, I am the most bullish on Amazon out of all of these businesses going forward. Now, if we also do a quick DCF on Amazon's business using its operating cash flow over the next 5 years, and we add in a 10% annual growth rate to Amazon's operating cash flow with 1% dilution and a 20 priced operating cash flow, which is still well below the company's historical average of 27, then we get a compounded annual growth rate to the stock of 14%, which is a market-beating return over the next 5 years. And in my opinion, these are pretty conservative metrics for Amazon's business, because its 5-year average growth rate to its operating cash flow is 24%. And again, its long-term average price to operating cash flow is at least 25. So this is a cheaper price ratio and significantly less growth than Amazon has seen over the past 5 years. And even with this lower price ratio and significantly lower growth rates, the stock could still deliver a compounded annual growth rate of 14% over the next 5 years. And for that reason, I do think that Amazon is still undervalued in the market today. And this is why it is the only Magnificent 7 stock that I have continued to buy and add to my portfolio. And those are all of the reasons why I also wanted to add Amazon as the second stock in this video. All right, now let's move on to the third stock that I want to talk about in this video, which is Lululemon. Now, Lululemon is an athletic apparel company in North America, and they're also expanding around the world, especially over in Asia and in China specifically. And the reason that I want to discuss Lululemon in this video is because the stock is down massively from its all-time highs. It's now down over 50% from its all-time high just less than a year ago. Additionally, if we take a look at Lululemon's stock on a 5-year basis, we can see that back in 2020, this was a $263 stock. And today, the stock is trading for $240 per share. What this means is that Lululemon's share price has not grown in about 5 years now. However, the company's revenue and its cash flows have continued to grow, and they are hitting all-time highs today. If we take a quick look at Lululemon's most recent earnings report, the CEO said, "In the first quarter, we saw strong momentum in our international markets. We continue to have a significant runway for growth and are confident in our team's ability to powerfully deliver for our guests in 2024 and beyond." The company's net revenue increased by 10% year over year to $2.2 billion. Its Americas net revenue increased by 3%, and its international net revenue increased by 35%. Comparable sales increased by 6%. America comparable sales were flat, but international comparable sales increased by 25%. Gross profit also increased by 11%. Gross margin improved. Income from operations grew by 8%. However, the operating margin decreased a little bit to 19.6%. So overall, in Lululemon's most recent earnings report, we can see that the revenue is continuing to grow, gross profits are up, and operating income is also up. However, the stock is down that 53%, and the stock has now been flat for 5 years. I also took a screenshot of Lululemon's balance sheet because the balance sheet is actually pretty dang strong. So here we can see that they had cash and cash equivalents of $1.9 billion, and total current assets of about $3.8 billion. Now, when we take a look at their total current liabilities, we can see that they were sitting at about $1.4 billion, which means that Lululemon has more cash than current liabilities, which means that Lululemon could wipe out all of its debt that is due within the next year with its existing cash position and still have roughly $500 million left over. So this company is very financially strong. Now let's head back over to Stock Unlock and take a look at its cash flows right here. So its operating cash flows in the trailing 12 months are now sitting at $2.4 billion. Its free cash flow is also sitting at $1.73 billion in the trailing 12 months. Now I always like to know, what is the company doing with its free cash flow? And if we take a look at Lululemon, we can see that in the trailing 12 months, they repurchased about $760 million worth of stock. They invested about $650 million into capital expenditures or expanding the business. And then they also increased their cash position by $950 million organically. So Lululemon is investing in growth, buying back a lot of shares, and growing its cash position organically. And this is a very nice cash flow statement, and Lululemon's management is being very prudent with the company's cash flow and deploying them, in my opinion, very well. The company also gave us guidance for 2024, and they said, for the second quarter of 2024, the company expects net revenue to be in the range of $2.4 billion to $2.42 billion, representing growth of 9 to 10%. For 2024, the company continues to expect net revenue to be in the range of $10.7 billion to $10.8 billion, representing growth of 11 to 12%. So in the third quarter, Lululemon is expecting revenue to grow by 9.5% in the mid-range, and for 2024 for the full year, they are expecting about 11.5% revenue growth. So the business seems like it is still expecting its revenues to continue growing for the remainder of the year, and it seems like their guidance for 2024 is still remaining to be quite strong. Yet again, the stock price is down quite a bit. Now, what's also interesting to me is if we go and take a look at Nike's revenue, especially over the past about year now, we can see that Nike's revenue has actually started to come down slightly in the most recent quarter, and it's been topping out for basically the past 2 years now. And Nike is one of Lululemon's main competitors. So Lululemon seeing its revenue continuing to grow, even in North America and in America, suggests that Lululemon is actually taking market share from some of the apparel giants like Nike. And this overall does suggest that Lululemon is growing its brand awareness and its overall moat and actually eating market share from its competitors. All right, now if we go and take a look at Lululemon's price to operating cash flow over the past decade, we can see that on average it has been 35.3. Now today, the company is trading for a price to operating cash flow of only 13.1, which is roughly a third of how the company has traded historically. Now, in my opinion, I do actually think that Lululemon got very expensive and overvalued in 2020 and in 2021 as the price ratios expanded massively. However, the company's share price has come down significantly at the same time as its underlying fundamentals have grown significantly, and that has led to an overall massive compression in the company's price ratios. In fact, if we take a look during the stock market crash of 2020, Lulu's price to operating cash flow got down to roughly 33. So the company is trading well below where it was during the stock market crash of 2020. In fact, if we zoom out, the last time that Lululemon traded for this price ratio was all the way back in 2009. So just like Amazon, Lululemon has not traded for this price ratio in roughly 14 to 15 years. And that is how bearish the market is being towards this business today. And it seems like the market has thrown out Lululemon shares. Despite the business still growing its revenue by 10% annually, and still expecting the remainder of 2024 to actually be a pretty strong year. And this company also has a really strong balance sheet and is taking market share from Nike. So I do think that the market arguably is being over pessimistic towards Lululemon right now. And in my opinion, this is making Lululemon stock look undervalued today. However, as I have said on my channel before, I do not invest in the fashion industry because it is out of my circle of competence. I don't know what makes a brand succeed over the long term. For example, I would think that Nike's brand would continue to grow and that business would not see a loss of market share. However, Nike is clearly losing market share to Lululemon right now, and that's not something that I would have been able to predict for Nike's business. And again, I just don't know what consumers are going to be buying 10 years out into the future, or if Lululemon's brand is going to remain attractive to consumers, or if consumers are going to find some new brand that comes up and takes Lululemon's market share. So for those reasons, I personally do not invest in the fashion industry because it's out of my circle of competence and I can't answer the question of what the business looks like 10 years out. But purely on a numbers basis and looking at Lululemon's metrics right now, it does look like the stock is cheap. And for that reason, I wanted to add it to this month's video. All right, now let's move on to the fourth stock in this video, which is HDB. This is a stock that I have not talked about on my channel for a very long time. However, HDB is actually in my portfolio, and I do think that this stock is looking cheap in the market today, and I will explain why here very quickly. First off, though, I just want to say that HDB is the largest bank in India, and India's economy has been growing insanely well, and it is projected to continue growing strong over the coming decades. So with HDB being the largest lender in India, and with India's economy growing, and with more people having access to credit and digital banking, I think that HDB is set up to have a very strong future because there are large tailwinds propelling this business forward, and this business is continuing to grow its underlying fundamentals very well. For example, the Indian digital lending industry is projected to grow by 33.5% from 2021 all the way out to 2030 and be worth $515 billion by 2030. Additionally, India's housing finance market is expected to grow at a compounded annual rate of 24.1% from 2024 to 2023 and be worth $2.7 trillion by 2033 as well. So again, I think that there are massive tailwinds behind HDB propelling this business forward. Now, what's also interesting to me is that back here in December of 2019, HDB's share price was $64.37. And today, the stock is trading for $60.60. Now, what this means is that the stock has been flat for roughly 5 years now, despite the underlying fundamentals of this business continuing to grow. Also, if we take a look, HDB's all-time high share price was $83 in March of 2021, and the stock is still down 27% from those all-time highs. Yet again, the business's fundamentals have grown significantly from that time. In 2023, HDB also did a massive acquisition that is suppressing the company's overall profit margins right now as they are working through the merger and acquisition costs. However, the business does seem confident that its net interest margin and net margin will expand over the next 2 to 3 years. And as that happens, I personally believe that there will be massive earnings per share growth for HDB. And when that happens, I do speculate that the share price will grow as well. So now let's dive into HDB's most recent earnings report. And here we can see that on a standalone basis, which is comparing HDB's business from a year ago versus the business today, factoring out the additional benefits from the additional revenue growth from the acquisition, we can see that a year-over-year comparison, the revenue grew by 23.4%. We can also see that the profit after tax grew by 35.3%. So HDB on a standalone basis is still seeing significant year-over-year growth. We can also see that its average deposits are up 25.2%, but excluding the merger, its average deposits are up 17%. Now, its average advances under management are up 54.1%, including the merger, but excluding the merger, they are up 16.7%. So overall, the bank is continuing to grow strong. We can also see that its customer base is now sitting at 95.1 million customers, which is up 2 million customers quarter over quarter. So HDB is continuing to gain market share in India and grow its overall customer base. However, as I said earlier, HDB went through a massive acquisition last year, which is causing the company to have a lot of mergers and acquisition expenses, and therefore its earnings per share has not grown in about 18 months now. And I personally believe that this is why the share price hasn't grown, is because typically investors want to see the earnings per share grow. However, due to its large acquisition expenses and costs, earnings per share has been muted for about 18 months now. But I do think that the company is going to work through this, and the company's overall net margin will continue to expand and grow back to its historical levels. Now, I also have some screenshots from the transcript that I think are very important. So this says, The key focus over the medium to long term, the medium as I define is between 2 and 3 years, is to focus on improving our profitability metrics defined as return on assets and earnings per share. So you can see that the management is clearly focused on increasing the profitability metrics over the next 2 to 3 years. Now in this next screenshot, the management says, but you have to be patient because these are things that will happen only on defined timelines. It's not something that I can call. In the meantime, if the organization grows, builds stability on its metrics, including core ROA and earnings over the 2 to 3 year period, has a positive trajectory. Trust me, we would have not just liquidity. We will have the ability to unleash growth with profitability coming back to pre-merger levels as well as on a core basis. Now, this last paragraph right here is the management telling us that they believe they can get profitability and net margins back to pre-merger levels. And why this is important is because if we head over to Stock Unlock right here and we go over to the company's net margin, we can see that it has absolutely fallen off a cliff since the merger happened. Pre-merger, the net margin was at 36.4%, and now it is at 25.2%. We can also see that the company's net margin was consistently around 33%. Now, I did all of the math already and all of the conversions with the conversion ratios between the currencies, and I found out that HDB is doing $34.7 billion in trailing 12 months revenue now. So if we multiply this $34.7 billion in revenue by a 33% net margin, then it means that in the trailing 12 months, HDB would have done about $11.45 billion in earnings now. The company's market cap is also roughly $140 billion today. So if we take $140 billion and we divide it by $11.45 billion in trailing 12 months earnings, then we get a price to earnings ratio of roughly 12. Now, a 12 price to earnings ratio for HDB, in my opinion, is actually quite cheap because this is a bank that is consistently growing its revenue above 20% annually. And historically, HDB has also traded for a price to earnings ratio above 20. So on an adjusted basis, if you do believe that this company can get its net margins back up to 33%, then on its existing revenue, it is trading for an adjusted price to earnings ratio of 12 and growing its revenues at above 20% annually and trading well above its historical average price to earnings ratio. And if you just take a look at this company's stock chart, again, the stock has now not gone anywhere in 5 years, but the company has continued to grow its revenue by over 20% annually over this entire period. So when they finally do get that net margin back up and they do get their profitability back up, once they work through this merger, then again, I do think that they are going to unleash a significant amount of earnings per share growth and propel that stock price back up. So for those reasons, I do think that HDB stock is actually looking quite cheap in the market today and trading for an adjusted price to earnings ratio of only 12 while still growing the business at over 20% annually. And for those reasons, I did want to include it in this month's video. All right, now the fifth and final stock that I want to talk about in this video is Airbnb. Now, if we take a look at Airbnb's stock chart, we can see that it is down roughly 32% from its recent high here in March of 2024. Additionally, from its all-time high back in 2021, the stock is down roughly 44.5%. So this stock is down from its all-time highs and down 30% in just a few months now. However, if we take a look at Airbnb's revenue, we can see that it is hitting fresh all-time highs and has produced about $10.5 billion in trailing 12 months revenue now. This is also the exact same story for the company's free cash flow, and it has produced about $4.36 billion in trailing 12 months free cash flow now. So what I am seeing is Airbnb's stock price is down, but its underlying fundamentals are continuing to grow and hit all-time highs. Now, if we quickly take a look at Airbnb's most recent earnings report, we can see that in the second quarter, its revenue did grow by 11% year over year. However, its net income was only $555 million, which was actually down year over year. And I do think that this is partly why the stock price did fall after Airbnb reported earnings. By the way, I also did a full video on my channel for Airbnb's earnings if you guys want to check that out and get a full analysis dedicated to Airbnb's report. But yes, Airbnb's net income was down year over year, and I do think that this was partly why the share price fell after earnings. However, we can see that the company's free cash flow for the most recent quarter was $1.1 billion, which was growth of around 18% year over year. Sorry, it was 16% year over year. So the company's free cash flow, as we already saw, is continuing to grow. Now, I also found this screenshot from Twitter, which shows Airbnb's year over year revenue growth rates. And we can see that in the third quarter of 2022, Airbnb's year over year revenue growth rate was 29%. And since then, it has been steadily coming down and decelerating. And now in the second quarter of 2024, it came in at 11%, which we can see was a pretty significant drop from its historical growth rates of even 18% in the prior year. Additionally, in the third quarter of 2024, Airbnb is expecting its revenue growth to come in at 9%, which is a further deceleration quarter over quarter. And this right here, I think, is the main reason why Airbnb stock fell so much after earnings, is because its revenue growth rate is decelerating and it is projected to continue doing so. Now, if we head over to Airbnb's conference call transcript, there are some really interesting things here though. So Brian Chesky, the co-founder and CEO of Airbnb, says, generative AI ChatGPT launched late November 2022. When it launched, I think we all got incredibly excited. You had the feeling that everything was going to change, but I think that's still true. But I think one of the things we've learned over the last, say, 18 months or nearly 2 years, 22 months since ChatGPT launched, is that it's going to take a lot longer than people think for applications to change. If I were to think of AI, I'd probably think about it in 3 layers. You have the chip, you have the model, and then you have the applications. There's been a lot of innovation on the chip. There's been a lot of innovation on the model. We have a lot of new models, and there's a prolific rate of improvement in these models. But if you look at your home screen, which of your apps are fundamentally different because of the AI? Like fundamentally different because of generative AI? Very little, especially even less in e-commerce or travel. And I completely agree with Brian right here, by the way. There's been a lot of hype around ChatGPT and these AI models that have come out. But when you look at your applications on your phone, there's actually not a lot of innovation that has happened. And there's not actually a lot of use cases that have happened for your average consumer to implement or benefit from all of these AI advances. And we have yet to see how they're actually going to impact us as consumers in a major way. So what Brian says here is what we need to do is we need to actually develop AI applications that are native to the model. I do think Airbnb will eventually be much more than a search box where you type in a destination, add dates, and find a listing. It's going to be much more of a travel concierge. It's going to have a conversation, learning, adapting to you. It's going to take a number of years for this to develop. And so it won't be in the next year that this will happen. So basically what Airbnb wants to do is actually create a travel app that leverages AI. And they want to make Airbnb much more than a search box where you type in a location and dates and you get a list of listings that you can stay at essentially. And they want to make Airbnb more of a travel concierge where you can talk to it and it will know your travel habits, the travel experiences that you like. It will have all of that past information and it will be able to suggest to you basically an entire travel outline and plan and book that travel or trip. And ultimately the outcome of this is Airbnb wants to create and deliver the best travel experiences from end to end for the consumer. However, they're not there yet, but this is where the company wants to go. And as someone who likes to travel the world a lot, I think that this would be incredibly cool. And I would definitely use this, but I just want to wait and see how this rolls out because it sounds cool, but you also need the profitability when you build products like this. So I'm not entirely sold yet. As a consumer, I would love to use this, but as an investment, I'm not entirely sold yet. Now let's head back over to Stock Unlock really quickly. And I want to take a look at Airbnb's cash flow statement right here. So we can see that the company produced about $4.36 billion in trailing 12 months free cash flow. Then their capital expenditures are basically nil. They're so low that Stock Unlock doesn't even show them right here because they're literally like $5 million a quarter. So Airbnb's operating cash flow, all of it basically becomes free cash flow for the business. So then the question is, what does the company do with all of this free cash flow? Well, we can see that they bought back $2.6 billion worth of stock and their cash position increased by $1.2 billion organically. So the company buys back a lot of shares and then it also increases its cash position, which is kind of like what Lululemon is doing. So this is a good cash flow statement right here. Now, additionally, Airbnb is selling for a price to free cash flow of only 17 today, which is a free cash flow yield of 5.9%. And this business is still projecting to grow its revenues by 9% this year. And in my opinion, a price to free cash flow of only 17 is starting to price in little to no growth for a business in our current market environment. So the fact that Airbnb is still projecting to grow at 9% this year, and it is trading for a price to free cash flow of only 17, does start to suggest to me that this stock is looking quite cheap, especially when we factor in that this is a highly profitable business with basically no capital expenditures, and it does have a very strong balance sheet. It's led by a great CEO. It's a very innovative company, and it looks like they are moving into new products that could potentially deliver more growth over the long term. That whole story right there does start to suggest, to me at least, that this stock could be looking cheap in the market. Now, full disclosure, I have not purchased any Airbnb yet, but it is a stock that I am actively looking into. And if I do end up purchasing, then I will definitely let the YouTube channel know. But with that being said, that is going to wrap up the video for today, everyone. And those are the 5 stocks that I personally think are looking cheap in the month of August. Now, if you did enjoy this video, then please remember to leave a like on it, as it does really help out my channel. And if you're new here and you want to see more stock market related content like this, then please consider subscribing to my channel as well. And lastly, if you are interested in checking out Stock Unlock, which is the platform that I use throughout the entire video here, it's the stock analysis and portfolio tracking platform that I personally use all the time, then right now you can go and get a 25% off your subscription. So if you've been waiting to check out Stock Unlock, or you've been waiting to go and get a subscription to the platform, then go now, because this sale is ending at midnight. And after that, you will not be able to get that 25% off discount. So don't wait, go and check out Stock Unlock. It's a great platform, and get your 25% off discount. But with that being said, that's going to wrap up the video for today, everyone. So thank you so much for watching. As always, I truly do appreciate it, and I really hope to see you all again in my next one.